Good day, everyone. I'm covering corporation fraud. There are two crucial dimensions of fraud systems. These are prevention and detection. Fraud prevention is the first line of defense in minimizing fraud risk. It is typically the most cost-effective component of a fraud risk management system because, take note of these three reasons. It possesses barriers to fraud, deters fraud, and can eliminate the need for costly investigations. It is implemented through preventive controls. Preventive controls includes human resource procedures, IT controls, and operational controls. Fraud detection. Fraud can never be fully prevented. Therefore, a highly effective fraud detection system must be in place to detect fraud as they occur. In the same way that a fraud prevention system requires preventive controls, the fraud detection system also requires detective controls. One of the most important fraud detection controls that the United States have been using is a whistleblower hotline, a service that enables employees and third-party suppliers to report malpractice, unlawful, or unethical behavior within the workplace. While the most common fraud detection is enhanced by process controls, such controls are designed to detect both fraud and errors, like reconciliations, independent reviews. Physical counts and inspections are also called as inventories, analyze, and audits. Well, prevention is better than cure, and detection is crucial to minimize losses and would also help the organization to identify errors, waste, and efficiencies. When you can just, for further information, just visit the link that I have provided. What causes an employee to commit fraud? Human behavior is complicated. A prominent theory of what causes fraud identifies three factors: pressure, opportunity, and rationalization. The theory is known to as the fraud triangle, documented in 1950 by UCLA professors. Pressure. Pressure may be a crucial element in many aspects of life. The need to be financially stable or some non-shareable problems such as high medical bills, gambling debts, or excessive lifestyle can motivate an employee to commit fraud. Second, opportunity is another factor explaining fraud and usually more obvious than pressure. This factor arises when an entrusted employee violates the trust by taking advantage of their position to commit fraud. Lastly, rationalization. The third factor is typically a person's excuse for committing the fraud. It is like an excuse of borrowing the money. Moving on with occupational fraud categories. It can be put into three categories: the asset misappropriation, corruption, and financial statement fraud. Well, actually, these three we are already familiar with these three. So I guess it wouldn't be hard for us to understand what does this three really means. Asset misappropriation is the most common form of occupational fraud, but the least costly and average. It occurs when an employee improperly uses an employer's asset for personal use. It is not simple as money being stolen by simple theft, as it can also occur when the employee borrows or misuses money for personal reasons. Best example is a case study about embezzlement that we have read and answered during our first activity. Asset misappropriation may occur in three areas of an organization: its revenue cycle, expenditure cycle, and production cycle. Next is corruption. Corruption is the second most common type of occupational fraud. The main form of corruption consists of an individual exercising their undue influence upon others. Examples of this form are conflicts of interest, bribery, improper gratuities, and economic extortion. Lastly, financial statement fraud. It occurs when an individual manipulates an organization's financial statements, misrepresentations that could result in some unauthorized benefit to the individual or to the entity or some other party. Best example of this is overstating revenues by recording future expected sales, inflating an asset's net worth by knowingly failing to apply an appropriate depreciation schedule, hiding obligations or liabilities from a company's balance sheet, and correctly disclosing related parties' transactions and structured finance deals. To reduce occupational fraud, an organization should be aware of its risk and internal weaknesses, implement effective controls, and have regular monitoring, internal and external audits, reconciliations, and even physical inspections. In general, controls that minimize opportunities and motivation along with strong fraud detection systems will likely translate into a reduction of losses due to fraud.
Distinguishing between high and low fraud environment. In high fraud environment, the company's internal control is weak, while in the low fraud environment, their internal control is strong enough that opportunity of fraud is not possible to penetrate. In high fraud environment, bonuses are based on financial metric or the performance of an employee, while as to low fraud environment, they have attractive fixed salary and incentives are fully compensated. In high fraud environment, there is poor promotion opportunities which would likely to lead to employees fraudulent act. Employees also in high fraud environment are undervalued, which results to their dissatisfaction of their job and aim for something better that they deserve. In low fraud environment, they usually have a culture of honesty and openness towards one another, which will help them to be satisfied with their jobs. Other environmental red flags. So what does it mean for a red flag? Red flag refers to undesirable situations or conditions that consistently contribute to fraud, waste, and abuse of resources. All organizations face fraud risk, which can either be internal or external. These are the environmental red flags. First, inventory shrinkage. Although it's normal to lose a few items of inventory when moving items, excessive inventory shrinkage may be an indicator of ongoing fraud. An auditor can detect inventory shrinkage by looking at the balance sheet, the number of products in stock, and those sold, and then comparing them with the previous records and projections. Second, missing documents. An organization may experience frequent cases of reported missing documents that relate to critical departments. When the frequency of occurrence becomes too often, it may be a sign of ongoing fraud within the organization. Third, multiple payments. There are cases when a company's accounting department may erroneously process duplicate payments to vendor or service provider. However, some employees may even process payments to non-existent companies with the intention of defrauding their employer. To prevent such errors, all payments should be monitored and verified that they are going to the intended parties. 4. Frequent complaints. Frequent complaints about a certain personnel or processes may be an indicator of fraud. When an organization receives repeated complaints about a senior executive, it should not assume that it's just an ordinary venting. Instead, it should conduct an investigation to identify the cause of complaints, effects, and any courses of action that they should take to make sure that there are no more complaints. Fifth, excessive number of adjusting entries. Making excessive adjustments without particular reasons points to cases of employees' fraud with the intention of hiding certain transactions. Adjusting entries should be accompanied by corresponding notes explaining the reasons of the adjustments.
Telltale signs of management and corporate frauds. First, let's define what is management and corporate frauds. Management fraud. It is a deliberate fraud committed by the company's management that injures investors and creditors, while corporate fraud is any frauds undertaken by the internal staff or external staff against the company. It includes employee theft, accounting fraud, tax evasion, insider trading, bribery or corruption, money laundering, and unlawful use of the company property. So let's proceed to the telltale signs of frauds. The following are the warning signs or indicators of frauds. First is missing records. It includes financial records or important transactions. Next is excessive variations to budgets. It is about the budget variance, whether it is favorable or not. And having lost assets, absence of audit trails, and delays in audits. Again, these are just some of the obvious indicators of frauds. So, what if fraud is committed by the internal staff? So, the warning sign is that we notice a change of behavior in a particular individual, just like being secretive or blaming others for missing records or having irregular invoice. Then what if fraud is committed by the external party? So the warning sign is that there is a sudden change of payment method along with threats and pressure.
So, good day everyone. I will be talking about the interpreting financial statement fraud through liquidity, profitability, long-term solvency, cash adequacy, and market ratios. And to start with, evaluating liquidity, current ratio, which is also known as working capital ratio, measures the or compares the current assets to its current liabilities, and asset test ratio, known as the quick ratio, compares the company's most short-term assets to its most short-term liabilities. And next is the receivable turnover ratio, uh, which is used to measure or quantify the company's effectiveness in collecting its receivables or money owed by the clients. Next is the inventory turnover, which shows how many times a company has sold and replaced inventory during a given period. Next is the evaluating profitability, which shows in rate of return on net sales, which measures how effectively a company turns sales into profits. Next is the rate of returns on total assets, which shows how effectively a company uses its assets to generate earnings. And rate of return on owner's equity measures how effectively management is using company's assets to create profits. And next is we'll talk about the evaluating long-term solvency. So the debt ratio measures the amount of leverage used by a company in terms of total debt to total assets. Debt ratio greater than 1 tells you that a company has more debts than assets, while a debt ratio less than 100% indicates that a company has more assets than debt. And times interest earned ratio is a measure of a company's ability to meet its debt obligation based on its current income. And next is evaluating cash flow adequacy. Cash flow liquidity ratio is a measure of how well current liabilities are covered by cash flow from operations. Defensive interval ratio seeks to calculate how many days a company can operate while relying on liquidity assets. Next is evaluating market ratios. Price earnings ratio relates to a company's share price to its earnings per share. Dividends yield displayed as a percentage is the amount of money a company pays shareholders for owning a share of its stock, dividend, or its current stock price. And that would be end of it. So thank you so much. And I hope that you will remember our previous lessons on this. And anyways, the formulas for each of the things that I have discussed is shown on the PowerPoint presentation. So thank you so much.
Good morning, everyone. Good morning, sir. Good morning, classmates. So today I will be discussing two topics about persons who commit financial statement fraud and categories of fraud. So this is my first topic, the person who commit financial statement fraud. So before we go on to the topic about persons who commit financial statement fraud, let's know first the meaning of financial statement fraud. As we all know that financial statements are important because it contains significant information about a company's financial health, and it provides information about a company's revenue, expenses, probability, and debt. So what is financial statement fraud? These are deception or misrepresentation that an individual or entity makes, knowing that the misrepresentation could result in some unauthorized benefit to the individual or to the entity, or some other party. So what is a misrepresentation? Misrepresentation is when you misrepresent or lie about something that happened, or a misstatement of the facts. So if the financial statement is being misrepresented, it obviously could result uh, benefit to the individual or the entity or some other party as stated. Financial statement fraud can take multiple forms, including overstating revenues by recording future expected sales, inflating an asset's net worth by knowingly failing an appropriate depreciation schedule, hiding obligations, liability from company's balance sheet, incorrectly disclosing related party transaction, and structured finance deals. So let's go to the main topic, the persons who commit financial statement fraud. So who are these persons? Financial statement fraud is usually committed by these persons in senior positions such as upper level management, CEOs, CFOs, CEOs, and owners. These are the people stand gain from a bottom line. So why do these people commit financial statement fraud? To help us better understand why individuals like executive commit fraud, let's use this concept, the fraud triangle. Fraud triangle. In this evolved fraud triangle, the possible fraudulent executive stands alone at the center as the great eye and is surrounded by 3 points: greed, pride, and entitlement. Greed executives want money, possessions, title, authority, perks, errors, and etc. Pride executives think that they are better, smarter, or skilled or superior. Entitled executives feels as though they deserve money, position, title, authority, perks, services, and etc. So here is the graphic form of the executive fraud triangle. So as you can see, uh, greed is the top of the executive fraud triangle. The executive wants for more, so will use his position and related authority to get it. So pride. Pride is one of the supporting legs of the executive fraud triangle. Executives that have too much pride or an inflated sense of self might think they are better, smarter, or more skilled or superior to others. They won't allow anyone to question their decisions. So, the last is the entitlement. The last leg of the executive fraud triangle. Executives feel they deserve anything they could possibly want: money, fame, a bonus, a football-sized office, a gorgeous assistant. They should get these things because they deserve them. This level of selfishness can lead to all sort of slimy decisions and behavior. So now let's go to the uh, authority the executive can. An assumption of the executive fraud triangle is that an executive has the power and authority, deliberate or not, to act as he wants, to be freely make bad decisions or commit outright fraud. Here are some powers and authority that the executive can: uh, undo internal controls, spend company money or privilege items that have no business purpose, make friends or hire friends or family and pay them large salaries, make unfair voting decisions, lie to auditors, hide spending in financial statements using improper reporting, so on and so forth. The executives is the top of the authority pile. He usually goes unchallenged or simply resolves those that dare to question. Some behaviors are fraudulent, others are an abuse of power. Misguided executives will lie or will cover up their behavior with lies. Others might simply be ignorant and arrogant. Now let's go to the categories of fraud. So there are literally dozens types of fraud. The Association of Certified Fraud Examiners, or ECFE, organized this into three fraud categories within their uniform classification of fraud. So the first category of the fraud is the corruption. Fraud arises from a conflict of interest and extend to the receipt of illegal gratuities. This type of fraud is difficult to detect and unfortunately not uncommon in government. Corruption is a form of dishonesty or criminal offense undertaken by a person or organization entrusted with a position of authority to acquire illicit benefit or abuse power for one's private gain. So the second point is the or second category of fraud is the asset misappropriation. The outright theft of cash or inventory is a form of asset misappropriation. Overpaying vendors or employees or paying vendors and employees that don't actually exist is another. Asset misappropriation is the common form of fraud, and cash schemes are the common type of asset misappropriation. Skimming of cash and cash larceny. This type of asset misappropriation consists of cash before it even enters the company's accounting system. It's very hard to uncover because it requires finding evidence of something that hasn't been recorded yet, and it doesn't require a lot of sophistication to execute, making it a popular choice among those that commit fraud. So the last category of fraud is the fraudulent financial statement. Since the composition of the government employees is generally not tied into profits or share price, this form of fraud is less common in public than the private sector. Still, fraudulent financial statements are employed by fraudsters in government to cover up other forms of fraud, such as asset misappropriation. Also, governments can be the victims of fraudulent financial statements they receive from the private sector in connection with bidding. So that
Good day, everyone. My report is all about overview of largest fraudulent financial reporting fraud. These are the top 10 accounting scandals in the past decades. Waste Management Scandal in 1998, Enron Scandal 2001, WorldCom Scandal 2002, Tyco Scandal 2002, HealthSouth Scandal 2003, Freddie Mac Scandal 2003, American International Group Scandal 2005, Lehman Brothers Scandal 2008, Bernie Madoff Scandal 2008, and Satyam Scandal 2009. In 1998, the Waste Management Scandal is a publicly traded U.S. waste management company in 1998. The company CEO, Maurice Meyers, and his management team discovered that the company had reported over $1.7 billion in fake earnings. The Securities and Exchange Commission, or SEC, found the company owner and former CEO Dean L. Bonrock guilty along with several others top executives. In addition, the SEC fined waste management auditors Arthur Anderson over $7 million. Waste Management eventually settled a shareholder class action suit for $457 million. And the second is the Enron Scandal 2001. Enron Corporation was a U.S. energy commodities and services company based out of Houston, Texas. In one of the most controversial accounting scandals in the past decade, it was discovered in 2001 that the company had been using accounting loopholes to hide billions of dollars of bad debt, while simultaneously inflating the company earning. The scandal resulted in shareholders losing over $74 billion as Enron's share price collapsed from around $90 to under $1 within a year. And SEC investigation revealed that the CEO, Jeff Skillings, and former CEO Ken Lay had kept billions of dollars of debt of the company balance sheet. In addition, they had pressured the company auditing firm Arthur Anderson to ignore the issue. And the third are the WorldCom Scandal, 2002. WorldCom was an American telecommunication company based out Ashburn, Virginia in 2002. Just a year after the Enron scandal, it was discovered that the WorldCom had inflated its assets by almost $11 billion, making it by far one of the largest accounting scandals ever. The company had underreported line costs by capitalizing instead of expensing them, and had inflated its revenues by making false entries. The scandals first came to light when the company's internal audit department found almost 3.8 billion in fraudulent accounts. The company CEO, Bernie Embers, was sentenced for 25 years in prison for fraud, conspiracy, and filing false documents. The scandal resulted in over 30,000 job losses and over $180 billion in losses by investors.
Good day. My task is all about financial statement fraud. What is prevention fraud or fraud prevention? It is vital to an organization whether it is large or small. Vital means necessary. So as an organization, it is necessary to have a fraud prevention in order to prevent losses and so on. So much for that, we have 6 strategies of fraud prevention. First, know your employees, because knowing our employees is needed for us as an owner of a business in order to prevent fraud. Like for example, if an employee feels a lack of appreciation from the business owner or anger at their boss, this could lead him or her to commit fraud as a way of revenge. Second, make employees aware or set up reporting system. Everyone within the organization must aware of the fraud risk so that those who plan to commit fraud will know that management is watching. Third, implement internal controls. It is the plans or programs to safeguard companies' assets in order to ensure the integrity of its accounting records, detect fraud and theft. Like for example, a retail store has one cash registered employee, one salesperson, and one manager. The cash and check register receipt should be tallied by one employee while another prepares deposit slip and the third brings the deposit to the bank. This can help reveal any discrepancies in the collection. Fourth, monitor vacation balances. It is one of the strategies of prevention. So, in order to know the fraudulent act of the employees, the company should let someone do their jobs when they are in vacation, or shall I say, a rotation of a job. Fifth, hire trustworthy expert. Of course, we should hire trustworthy experts so that we can feel confident to our information and so on. 6. Or last, leave the corporate culture. It is very important to an organization to have an open door policy because it provides a great fraud prevention system as it gives employees open lines of communication with management. So, we move on to fraud detection. In addition to prevention strategies, we should also have a detection method in place and make them visible to the employee. And that's all. Thank you.